Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to creating a production schedule and schedule of cash payments. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 432 production schedule and schedule of cash payments tab in the practice problems section. Closing this back out, we're going to have our information up top. We'll read through all the information, then we'll have a smaller component of that information we will then use to work through the practice problem. So first we have the expected sales. This is going to be the expected sales actually in units. So these are the units that we expect to sell. And we have March, April, May, and June. We're focusing in here on March, April, and May. We're going to need June's information in order to work through our production schedule. We then have the ending inventory equal to 2.5 times the expected sales in the following month. So when we think about our production schedule, how many units that we are going to be producing, we're going to project out into the future month and then be saying that we want the desired ending inventory, the cushion, as of the ending of the time period to be equal to 2.5 times the following projected sales units. So we're going to have that kind of staggering element that we will see in our schedules when we're thinking about these kind of items related to that projection that we will have. And then we have the materials cost per unit is going to be $8. That's going to be the cost of the materials. They're going to be paid the month after production. That means we're going to buy the materials and then they're going to be paid for the month after, so they're going to be going through then the accounts payable. So we're going to have the accounts payable. That means we're going to have kind of a staggering process then with the payment schedules as to the when they're purchased, the materials going through accounts payable and then paying them in a following period. So then we have the labor costs per unit are going to be $11. They're paid in the month incurred. We have fixed overheads. You can think of something like the rent that's going to be the same across the time period. That's going to be the $30,000. We have the dividends paid in May. So dividends meaning we have accumulated earnings and we're going to pay some of them out in the form of dividends. Those will be paid in May, 20,000 units produced. February are going to be the 24,000 units that were produced in February. So we then have the expected sales. Well, this is going to be the same information in a smaller format so that we can then use it in our schedules. We're going to start off with the production schedule. Now, when we look at the production schedule, we are focusing in on March, April, and May. The red items, February and June, are there only to help us to do the calculations within the heart of our schedule, which is March through May. That helps us out so we can see how the calculations are done all in the same schedule. In Excel, they would help us out to make the formulas kind of uniform across. If we worked this in Excel, and I highly recommend you practice them in Excel, we do have these in Excel as well, we could then hide these columns if we wanted to basically present this in a way without having those columns, right? And still use them in order to build the table so we can see where this is being produced from. If you're doing this in a practice problem, then of course you want to include these items so that you can easily see them as you go through your practice problem and put this information together. So we're going to say, all right, we have the projected. So in other words, also note that means if you're given a practice problem and you're given months that aren't in your schedule, you may want to just add them in your schedule as you build them so that if you need them, you can add the information in to that box as you go through. And if you don't need them in the production schedule, then that's fine. You have a column that you're not using in that particular schedule that you're working at. So if you're building these for a practice problem and you're given months that aren't in the months that you're going to be calculating for, such as June, such as February information over here, if you have an added column that you don't use, then that's easier to work with than not adding a column that you need and then not having it and trying to, because you can't put it back in there unless you're working with like Excel or something like that where you can add it at a later time. So if you're drawing it by hand, then it's harder to add a column, obviously, than to simply not use one that you have added at the beginning. Okay, so then we have the projected sales. So we've got the 22, the 25, the 23.5, the 20. That's going to be here in March, April, May, and June. These are the units sales. Remember, these are the projected unit sales. We're doing our production schedule, meaning how many units do we need to produce? How many units do we need to produce? That starts with the sales in units that we're projecting. Then we need to add to that the desired ending inventory. Now, the desired ending inventory, we want 2.5 times the expected sales in the following month, which seems like a lot, right? That seems kind of, but it depends on the industry that we're working in terms of how much ending inventory we might want, right? Some companies might have a just-in-time type of system where they have very little in inventory at any given time. Other companies may need, for whatever reason, to have fairly substantial inventories, especially if they're dealing with volatility in the market or something like that. So we're going to say, all right, that means that for February, and we're going to calculate this for February as well, and we're going to say that we'll look into March. So March is 22,000 on the sales. That means we want expecting ending inventory. So we're basing our ending inventory for this month based on the projections of the sales in the following month, and we're going to say times, what did it say, 2.5, and that's the 55,000. So if we did that all the way across, we'd say, okay, so then we're looking at March's number here. So we're going to look at this 25,000 times 2.5, and there's our 62.5. And then we're going to be looking here, we're looking at the 23,500 times 2.5. That's going to, let's do that again, 23,500 times 2.5. That's going to give us our 58,750, and so on and so forth. Or so there's one more so on. So like a so on and no so forth, just one more. And then we have the total units required then. And notice I'm not calculating for February or June. I'm focusing in on the heart, and I'm only going to use February and June for those items that may be needed in future calculations. So we're going to add together the production, the units we expect to sell, plus the ending inventory, now getting to that total units required here for March, April, and May. And then we have to take into consideration the units that we already have on hand in the beginning inventory. And this is where this is why we needed this February number, because if this is the desired ending inventory, that then will be our beginning inventory over here. So we have this kind of staggering feature once again. Here's the ending inventory. That's going to be the beginning inventory here. Ending inventory is going to be the beginning inventory here. And then April's ending inventory is going to be May's beginning inventory. We don't need anything for June because that's outside our scope. So then we're going to be taking the units to be produced is going to be equal to the units required for the period minus the beginning inventory that we already have on hand. So once again, these are the units that are both the ones we think we're going to sell and the ending inventory we want minus the units that are already on hand gives us the units that we need to make, the units we need to produce. And that, of course, same process here for April. This is the units we need. We already have the 62.5 on hand, or we expect to in our projection, and that's going to give us the units we need to produce, 21,250. Okay, so once we have that information, we can go into the cash payments. So we're going to think about the cash payments that we are going to have now. One of the most complex components of the cash payments will be dealing with the materials, because it will often go through the accounts payable where we have that kind of staggering type of process. So I'm going to pick up the same units produced. These are going to be the 24,000, which was given in the data for February now. And then we have March, April, and May, where we have just calculated March, April, and May up top in the production schedule. So now that we have the units produced, we can think about the payments. Let's think about the payments related to the materials. So the payments related to materials is going to be $8. So we've got the $8 that we're going to be paying for the materials, and we're also going to be paying for them the month after. What it said paid the month after production. So we could have added another line, as we've seen in the past, and say, well, these are going to be the purchases on account that we're going to have, and then stagger it. So and then stagger the amount that we're going to pay in the following month. In other words, if we looked at February, I could say we have the 24,000 times the $8 for the materials, and that's going to give us the 192. So the 192,000 we could put here then as the amount that's going to go be in accounts payable that we're then going to pay in the following month. We're going to pay them in March. Or we could skip that line and not have that there and just realize that we're going to be paying that amount then in March. So we're going to be paying March $192,000 for purchases that happened in February. And of course, we can repeat that process. So we can then take the $29.5 for the products, the units produced in March times $8. That's going to give us the $236 that we could put into accounts payable purchasing in the month of March, which we would then pay for in the cash flow statement, which we're working on here in April. So one more time, let's do one more since this is we're going to take the $21,250 times the $8. That would be the $170,000. Once again, that would go into AP when we purchase them in April, which we would then pay for in May for the $170,000. So then we got our other payments. We've got the labor costs. So it said that the labor here was $11 per unit. So, and we pay for them in the same time period. So we would simply then take the units that we have, which is going to be the $29.5 in March times $11. That giving us the $324.5. No staggering process here. We're just going to keep those in the same time period. $21,250 times 11 would then give us that $233,750 and so on and so forth. We then have the fixed overhead at the $30,000. Fixed overhead, like rent, you can imagine, is going to be oftentimes a fixed cost, which is going to be the same across the board, which is nice and that'll be often the case for a lot of expenses, right? We expect to spend the same amount each month, possibly. So we would then copy that across. Then we have the dividends. Now remember, what the dividends are going to be the accumulation of earnings that we're then going to decide to pay out to the owners in the form of dividends. They're not going to be on the income statement. They're going to be something that the income statement shows what we have earned, net income, bottom line, that we have now chosen to pay some portion of those earnings, the earnings over the lifetime of the company, back to the owners in the form of dividends. It says that we're going to pay that in May. So we're going to pay out dividends of $20,000 in May, or that's the plan. That's going to give us the total cash payments, which are going to be including everything from the payments on down, the materials, the labor, the fixed overhead, the dividends, and that'll give us then the cash payments, bottom line, across the board. Again, I highly recommend working these in Excel because just building these tables, it seems like a basic table to build, but really these are things that the more you do them, they just become automatic, and these are just perfect examples to just practice the basic skills, just formatting a table, putting the underlines on it, double underlines, adding decimals when you need it, adding, rows and whatnot if you need it, working on formatting and copying and pasting formulas in the most common ways in Excel, and just recognizing how to do those and how Excel will work kind of second nature. Or Google Sheets, same kind of process. Highly recommend using one of those two, whichever you prefer or have available to you.